that in the first time in 25 quarters, ELF is facing its first net sales negative growth. Hi everyone, in today's video, I'd like to share about my thoughts on the latest ELF earnings call, how they did, and why I bought the dip on ELF after the 25% obliteration of its share price. Let's take a look at its share price recently. If you can see from the last 5 days, after the earnings call, it actually fell as low as $34 before bouncing back up to currently around $73. How did ELF Beauty actually perform recently? If you were to look at the year-to-date results, you can see that it actually fell up to 41%, and from a 1-year perspective, it went up as high as 217, and it fell all the way down to the current $73. So what caused it? We should quickly look at its current latest earnings call. If you can see from its Q3 2025 results, they did pretty well. They actually increased their net sales by 31%, which is pretty high. And even during the current situation and the market conditions, they increased their market share as well. So definitely this quarter is not the issue. So the key culprit here is the guidance for the next quarter. You can see that they actually gave an updated fiscal 2025 outlook. Previously, they expected 28 to 30% increase, and now they actually adjusted it to 27 to 28% year-on-year increase. This might not seem to justify the 25% drop. Furthermore, if you were to look at the net sales growth outlook, they actually shared that for the second half of FY 2025, they will increase by 14 to 16%. And definitely this is a big drop from the 77% from the second half of FY 2024. But why is there such a big drop? This is because this number isn't what it seems. If you were to dive a bit deeper, you can see that from the 14% to 16%, let's assume that 14% is the increase for the net sales for the second half of FY 2025. If you were to look here, you can see that we can get the numbers from here. And the second half of FY 2024 revenue is 270 million and 321 million. So let me add it up here. 213 plus 270 equals sum. And you get 591. So this is the revenue for the second half of 2024. But remember that we wanted to know what is the second half of 2025. So the second half of 2025, if you were to take the lower end of the guidance, which is 14%, we should multiply this by 1.14, which gives us the figure of 673. And for this latest quarter, Q3 of 2025, the net sales is 355 million, which means they are expecting Q4 2025 Q4 2025 net sales to be $318 million. This might not seem significant on its own, but if you were to compare its Y-on-Y results, if you would look into Q4 2024, which we can get a figure here, Q4 2024 is 321. What does this mean? This means that in the first time in 25 quarters, or should I say 24 quarters, ELF is actually facing its first net sales negative growth for a quarter. ELF has always been a high growth stock story with ambitious valuations. Even they themselves have always emphasized their growth story. Let me just show you the slide. They will always show this slide at the beginning of their presentations, and they are always proud that they are having 24 consecutive quarters of net sales and market share growth. And this is the reason why ELF actually command a higher valuation compared to the rest, because they are able to grow their net sales consecutively for 24 quarters. Imagine next quarter having a negative growth. First off, they will not be able to continue their growth, and ELF being a high growth stock commanding ambitious valuation, it is definitely very devastating to have a negative net sales if they were to get it next quarter. But of course, if they were to achieve, let's say 15 to 16%, this will definitely be way better. So let's say if you were to change this to 15% or even 16%, they will have increased the net sales by 3%. This is not really a great result for ELF, considering the share price of ELF currently. During the earnings call, ELF actually also shared the 4 key reasons why they have a slower revenue growth. I think one of it is because in January, TikTok is giving them some issues. Their social conversation was way down over 20% due to the wildfire in LA, and also the opening or the closing of TikTok. So ELF is very reliant on social media marketing to drive their sales. Hence, they are being affected by the lower social conversations. They are definitely facing a couple of headwinds. One of it is that the cosmetic category as a whole shrunk by 5%. And furthermore, in 2024, they had one of their biggest launch, which is their lip oil. And they did a sell-in to their retailer in December. So they clocked their sales in December in Q3 of 2025. So this will actually cause a high benchmark for a comparison the next quarter. I know this because I am in Razer previously, and when we were to sell the inventory to them in December, they will need time to clear off the inventory for the next couple of months. Hence, by selling it in December, in January, the retailers are still selling the stocks that they have acquired from ELF in December. So they are unable to purchase more inventory from ELF. This resulted to a slow start. Furthermore, one of the reasons why there was slower growth was because ELF thinks that the consumer have a little bit of hangover from the highly promotional period in December. So everyone is actually buying their stuff in December due to the promotional period. ELF did not do the promotions, but many other brands did. So if the consumer bought most of their stuff in December, most likely they will need some time to use up their cosmetic in January and purchase more of their products in February or March. Do I think that TikTok is actually a major concern? I don't think so. I think it's only temporary because the wildfire should stop in 2025, and most likely the social conversion will most likely pick up in 2025 and 2026. In terms of the category issue of it shrinking 5%, I think ELF is able to increase their market share to make up for the shrinking market. So this shouldn't be a major concern. Furthermore, if you were to look into it, they also have other markets like skincare, which is actually growing at 4% as well. What I also like about ELF is that they are constantly increasing their channel partners, and they are growing both internationally and domestically. So from the international net sales, they actually grew it by 66%. And previously, the international business is only 15% of the net sales, and currently it's already at 20%. And it will most likely continue to grow. Being in 15 countries like Germany, Netherlands, Italy, and Mexico, I think ELF is well positioned to capture more sales in this current market condition because they are positioned as an affordable cost leadership company. So they are able to sell good products at a cheaper price. Hence, at this current market conditions whereby even the European countries are not doing as well as before, this will most likely result to people buying more affordable cosmetics. ELF not only focus on their international net sales growth, they are also focused on their domestic growth as well. They did announce that they will be partnering with Dollar General to provide ELF's products to the thousands of stores in the States as well. And this will definitely increase their net sales. So am I worried about the revenue? I don't think so because I do believe in their international net sales growth and them being able to grow their market. So in general, I'm not so concerned on their sales growth. I think there's still a lot of potential. There is also another key headwind, which is the China tariff war. Why is it that it is actually a huge headwind for ELF? Is because for ELF, they manufacture most of their products in China. More than 80% of their products are made by third-party suppliers in China. So if the tariff were to be implemented as per the rhetoric by Donald Trump, ELF would definitely be impacted. But I have done the math, so we can see if ELF really be heavily impacted. One of the solutions that has been suggested by ELF is to increase the price of their products. So if you were to look at their products, currently they are selling around $14 versus their prestige competitors at $49. And for example, like $10 versus 38, $8 versus 40, $12 versus 38. What we are trying to conclude here is that their prices are definitely way lower than their competitors. Hence, there is potential for a price increase without decreasing their market growth. So, looking at this, let's take this for example. Currently, the competitor is at $38 and ELF's product is at $12. The revenue is $355 and the cost of the products is actually $102. So, if you were to do the math here, 102 divided by 355 is 28 to 29%. So the cost is actually 28 to 29%. So let's say the price is $12 here. The cost is 30%, right? Goes to 3 times 12. And the profit margin of 70%, which is minus the price minus the COGS, which is $4.8. So assuming that the tariff will actually increase only by 10%, which is what has been implemented currently, here I will actually multiply the cost by 10%. And my price, I also increase by 10%. Here I'll actually have a increase in profit margin instead. So this is definitely not a problem. And furthermore, if Donald Trump would implement the tariff, which is 60%, which he did mention. So here, let's increase it by 60%. And let's assuming that we increase the price by 20%, right? You will realize that just by increasing the price, even if Donald Trump were to increase the tariff to 60%, just by increasing the price by 20%, ELF is still able to increase its profit margins. So this is because the cost of goods sold is only 30% of the price, which means that even if you were to multiply it by 60%, the increase is not as much. Hence, this can be easily mitigated. Furthermore, ELF has already came up with plans to resolve these issues. If you were to look at it, they even have a tariff playbook. They can get the supplier concession, favorable FX rate, which means that the yuan might depreciate, the cost savings from bulk purchase, price increases, the one that I've done the math, international growth, and supplier diversification. So with all this in play, I don't think tariff is a big issue that ELF is unable to resolve. If you were to really look at it, this price of $14 is nothing compared to the $38 that their competitors are selling. Hence, this is not really an issue here. So why I bought the dip is because I think there's still a lot of revenue growth potential, and it's not really that expensive at the current price, especially if you were to compare it to Estee Lauder. So I decided to start a position. I bought the stock at around $65, and I did some option trading as well. If you're interested in my option trading, do subscribe and like the video and let me know. And if possible, I will share more on it as well.